Welcome back. In this lesson, we shall learn about financial positions, in particular short positions and also leveraged positions. Let's begin. We've learned earlier that more frequently traded assets are securities, commodities, currencies, and real assets, as well as contracts, with such assets as the underlying. In order to achieve his financial goals or manage financial risks, an investor has to take a position in an asset. The investor takes a long position when he owns an asset. Long positions benefit from an appreciation in the prices of the assets owned. The investor profits by purchasing at a low price and selling at a high price. Conversely, the investor takes a short position when he has sold assets that he does not own. Short positions benefit from a decrease in the prices of the assets sold. Short sellers profit by selling at high prices and repurchasing at lower prices. Contracts have long sides and short sides as well. We've learnt that contracts can be forwards, futures, swaps, and options. The long side of a forward or futures contract is the side that'll take physical delivery or its cash equivalent. The short is the side that is liable for the delivery. The value of the long increases when the value of the underlying asset increases, while the value of the short increases when the value of the underlying decreases. In swaps, each party is long one asset and short the other, so the designation of the long and short side is often arbitrary. Usually, the side that benefits from an increase in the quoted price or rate is referred to as the long side, and the other side will be the short. For options contracts, the identification of the two sides can be confusing for some. Try remembering it this way. The short is the writer of the contract, and the long is the holder of the contract. By holding the contract, the long holds the right to exercise the option. The short must satisfy the obligation if the long chooses to exercise. There are call options and put options. Call options give the long the right to buy the underlying from the short, while put options give the long the right to sell the underlying to the short. Now, here is an anomaly. The put holder has a direct long position in the put option contract, but an indirect short position on the underlying. Therefore, the long put benefits when the underlying price goes down, while the short put benefits when the underlying price goes up. This goes against the common notion that the long benefits when price goes up and the short benefits when price goes down. Besides investors, hedgers also take positions, not to profit, but to manage risks. For example, an oil producer will go short on oil forwards or futures as it wants to benefit when oil prices drop to offset lower revenue from selling its oil. Conversely, an airline which is a consumer of oil will long oil forwards or futures to benefit when oil prices increase. This is to offset the increase in fuel costs. To determine what position a hedger should take, think of what the hedger has to do in the future. The airline has to buy oil in the future, so it should long oil futures. The producer has to sell oil in the future, so it should short oil futures. For securities, long positions are easily understood. The investor buys the security with cash, receives all dividends or interest while holding, and receives back cash when the security is sold or redeemed. Short positions are less easily understood. At initiation, the short seller simultaneously borrows from a security lender and sells the security. The proceeds of the short sale must be left on deposit with the lenders as collateral to guarantee the eventual repurchase of the security. The short seller may also be required to deposit additional margin in the form of cash or short-term riskless securities. The lender then earns interest on these funds and may return a portion of this interest to the short seller. This is at a rate referred to as the short rebate rate, typically 0.1% less than overnight interest rates. If the security is difficult to borrow, the short rebate rate may be lower or negative. Besides, the short seller must pay to the lender all dividends or interest that the lender would have received from the security. These payments are called payments in lieu of dividends or interest. Short sellers close their positions by repurchasing the securities and returning them to the security lenders. This process is commonly known as short covering. Let's move on to leveraged positions. In many markets, traders can buy securities by borrowing some of the purchase price. The amount of purchase that is financed by borrowing is called the margin loan. Such an arrangement is called a margin purchase, where the amount that is borrowed is financed by the broker. The amount which is financed by the trader himself can be termed as his equity position. This amount must meet the initial margin requirement, which can be set by the government, exchange, clearinghouse, or broker. The leverage ratio of a margin investment is the value of the asset divided by the value of the equity position. For example, if the value of the asset is $100,000 and the equity position is $40,000, the leverage ratio is 2.5 times. This means that a 10% increase in the value of the asset results in a 25% increase in the investor's equity amount. The reverse is also true. So, as you can observe, the use of leverage magnifies both the gains and losses. This additional risk is referred to as risk from financial leverage. To protect themselves from a sharp drop in asset value, brokers usually enforce a maintenance margin requirement on the trader. This is the minimum equity percentage that the trader must maintain in the account. This is typically 25% of the current position value, but brokers may require a greater minimum equity percentage for volatile stocks. If the percentage of equity in a margin account falls below the maintenance margin requirement, the investor will receive a margin call, a request to bring the equity percentage in the account back up to the maintenance margin percentage. An investor can satisfy this request by depositing additional funds or depositing other unmargined securities that will bring the equity percentage up to the minimum requirement. If the investor does not meet the margin call, the broker must sell the position. So, how do we determine the price of the security to trigger a margin call? Remember this formula, where P0 is the initial purchase price. Back to our example. The initial purchase price was $100,000 and the initial margin was 40%. If the maintenance margin is set at 25%, the margin call price should be $80,000. A margin call will be triggered if the price of the security falls below $80,000. Now, let's do a calculation. Assuming that exactly 1 year after the margin trade initiation, the price of the security falls to $72,000 and the trader is forced to sell the security as he cannot meet the margin call, what is the percentage loss incurred by the trader on his initial investment of $40,000? Before we proceed, we have to realize that there are other forms of cash outflows besides the loss from the drop in price. Firstly, the trader must pay the broker interest on the margin loan at a rate known as the call money rate. This rate is generally higher than the government bill rate. For larger investors with better collateral, the call money rate is lower. Besides the interest on the loan, the trader typically has to pay a commission for the purchase and commission for the sale of the securities. This is paid on the entire position, not just the borrowed portion. Let's assume that the call money rate is 3% and the commission for purchase and sale of the security is 0.25%. We can now calculate the actual loss incurred by the trader. To make things more interesting, let's assume that there was $4,000 dividend received during the year. Let's first calculate the amount of money the trader paid out to initiate the position. The commission paid to purchase the security was $250. Add this to the $40,000 the trader placed as margin, and the total amount paid out was $40,250. And 1 year later, when the security was sold, $180 commission was paid for the sale. $72,000 cash was received from the sale, and we also add in the $4,000 dividend received. The interest paid for the year was $1,800, and $60,000 was used to repay the loan principal. If we sum all these up, the total amount the trader received back was $14,020. If we plug in these two figures, the holding period loss was 65.2%. Quite a hefty loss. And to end this lesson, now's your turn to make some calculations. Terence made a margin purchase of 100 shares of ACGM Corp at $250 per share and sold all the shares at $280 per share exactly 1 year later. During the year, he received a total of $12 dividend per share. The initial margin requirement was 25%. The call money rate was 4%, and the commission for both purchase and sale was 0.3%. Calculate Terence's return on this transaction, taking into account all fees. Pause the video now and work out your answer. And we're back. Let's first calculate the total amount Terence paid at initiation. The total purchase price is $25,000. He must post 25% margin, which is $6,250. The remaining $18,750 is the margin loan. The commission paid on the purchase is $75. Therefore, the total initial equity investment by Terence is $6,325. After 1 year, the stocks are sold for $28,000. The commission paid on the sale is $84. We also include the dividends of $1,200 as gains. Interest paid to the broker on the $18,750 loan for 1 year is $750, and $18,750 of the proceeds goes to repaying the margin loan. Summing up all of these, Terence receives back $9,616. Work out the gain, and we get a figure of 52% for the transaction. And that's all for this lesson. Up next, we look at order execution. See you soon.